Hi, Martin Turner here. This week we have our second lecture on understanding the past. We start with a review of how we can see our firm as having clearly separate operating and financial activities. We then look at how we can analyse return on equity, ROE, into leverage, profitability and efficiency. And I take you through how I can do this for Ryman Healthcare. We also discuss some issues with focusing on the operating activities of a firm. And first, we start with a review of how we can separate operating and financial activities of our firms. Hi, welcome everyone. This week we're going to be looking at understanding the past. This is the last 2 weeks of us looking at this topic, weeks 5 and 6. So we'll go through some of the material in these slides today and then the rest next week. So what we'll be looking at, we'll review briefly one or two key matters from last week. Then we're going to focus on analysing return on equity. There's a really good video. On that, and it's a really good video on that called Analysing Return on Equity. Welcome, Chan. You grab a seat, and you can see that we'll be looking at in the video it sets it out, and we'll be looking at it today. Leverage, profitability, and efficiency. We'll be breaking down the elements of return on equity into those three aspects. Analysing is all about breaking things up into bits so we can focus on key aspects of our business that are driving value. Then we'll be looking at the accounting drivers of our return on equity and just touching on where we'll be going in terms of looking at the economic and business drivers. Here's the chart. Here's a chart which possibly is, for many people, can be the most important thing we do. This way that we view the firm. And we looked at that last time. And this is where we see the firm as having separate operating and financial activities. And in restating our financial statements, the purpose of that is to clearly separate those two aspects of our firm. And so we'll be focusing on the operating activities and less so on the financial activities as we look to see what's driving value. And we'll be getting to that where we'll be clearly just looking at the enterprise as we progress through the unit. At the moment, we're focusing on return on equity. Abnormal earnings, which is our economic profit, equals return on equity minus the cost of capital for equity. Remember, we show it as ROE minus 1 times book value of equity. That's our economic profit model. We're focusing on the whole company still at this stage, and we're looking at return on equity. And so what we're going to do now is analyse return on equity. And we're going to break it up into those three aspects of leverage, profitability and efficiency. And first of all, we're going to focus on leverage. Leverage is a wonderful thing. If you can get it working for you, it is so good. It works a lot in all aspects of life, but including in business. Now leverage, we can look at leverage, for example, as total debt to equity or total debt to total assets. And the total debt, that can be total liabilities of our firm, or it could be the interest paying liabilities of our firm. Either's fine. As we know, that there's no fixed way of doing of terminology nor of how we calculate ratios in accounting. From my private equity background, we tended to focus, in terms of looking at debt to equity, we tended to focus on the interest paying liabilities. But either's fine. Liabilities are all the same in that we've got to pay them back. We're expecting to have an outflow in the future. The interest paying liabilities are ones where we're actually got to pay interest as we go. So leverage, this is what we're going to look at as an element of driving return on equity. Total debt to equity, total debt to total assets. So the total debt to total equity, we can look at the financial leverage, FLEV. F for financial, LEV for leverage, FLEV, financial leverage. And we're looking at it as net financial obligations divided by equity. We can identify our net financial obligations from our restated balance sheet. And net financial obligations is a little bit similar to the interest-paying liabilities, because the net financial obligations will tend to be interest-paying ones, but it's net of our financial assets. So net financial obligations to equity. That's what we're going to be looking at as financial leverage. So operating liability leverage, another type of leverage, OLLEV, operating liability leverage, that's the operating liabilities divided by net operating assets. You can see here we've got the operating activities here. So operating liabilities, and we'll see from Ryman's they have quite a few of those, divided by the net operating assets. Again, these are things that we identify in our restated financial statements. So we've got financial leverage and operating liability leverage. Now, the magic of leverage. Leverage is a wonderful friend. Leverage for equity investors means that we can get different returns than is earned from the firm's operating assets. Now, so we're not constrained as an equity investor to what the firm can actually earn on its operating assets. This is the real world here, isn't it? What can they earn on the operating assets? We can earn a different return to that. I learned about leverage when I was at high school. I remember we did leverage in science. You know, you had the big lever, and I remember Archimedes, you know, he figured out that he could move anything. If he had a big enough lever, he could move anything. He could move the whole world, you know. I thought, man, and if at school, if that's all I learned and I missed everything else, that would have been brilliant, because leverage is such a key concept. Let's have a look how it works for Ryman Healthcare. Ryman Healthcare's operating assets were $5,796,000,000. That's at the bottom of that table. And this table here, taken out of the study guide, table 4.7, shows how the operating assets of Ryman Healthcare are funded. About half, 48% of its operating assets are funded by its operating liabilities, $2.787 billion. So it's got a lot of operating liability leverage. It's a key part of the Ryman story on how it's making money. And that's pretty unusual. And a lot of its operating liabilities, which is also unusual, is coming from its customers rather than its suppliers. And we'll look at that a bit more. Then we see that 18% of its operating assets are funded by net financial obligations. That's the debt. So it's got 18%. Your firms might have a bit more than that. And then it's got ordinary shareholders' equity. Its equity is funding about a third, 34%, $1.940 billion. Its issued capital is $33 million. That's what the shareholders have actually put in. But its book value of equity has been growing strongly each year. It's now $1.940 billion. And that's the third. So that's how the operating assets of Ryman Healthcare are funded. And you can see how your firm is funding its operating assets. Now, the magic of leverage is that the returns the firm can provide their equity investors are not limited to the returns generated by their operating assets. Is this too good to be true? You know, can we make more than our firms actually earn on their operating assets? Well, let's see how this works with Ryman Healthcare. Ryman Healthcare is making 9.8% return on its operating assets, which is quite a strong return. You'll find what yours are. Often they can be sort of 6 or 8%, 6%. So 9.8% is quite strong. It's on the stronger end of the range. So that's the return it's making on these growing amount of operating assets it's been building up. but its return on equity that it provided to its equity investors in 2018 was 21.4%. Now, there's a big difference between earning 9.8% or 21.4%. You get seriously rich earning 21.4%, if you can do that consistently. Ryman's has been earning more than that consistently. If you get your calculator out and just go 1.214 and then just times itself over 10 years or so, just see how big that number gets. And you can compare it with 1.098, which is a 9.8%, and do that over 10 years, which is quite a reasonable return, but boy, 21.4% you get rich. One of the richest people in the world, Warren Buffett, started with 100 grand when he first started investing seriously, and his firm, Berkshire Hathaway, over 50 or 60 years has been able to average around 20% per annum compound. If they can keep doing that for another, say, about another 300 years, they'll end up owning the entire world. 20% over 50 years gets you to be one of the richest people in the world, and to have made a lot of other people incredibly rich. Everyone who invested with him in the early days, they're all billionaires who stuck the distance. 20% you get seriously rich. 10% return on equity is pretty average for the share market. So it's perfectly fine. But Ryman Healthcare, through leverage, its leverage that has turned its return on operating assets of 9.8% to 21.4%. So to understand what's driving that return on equity, leverage is a key part of the story. It's not the whole story, but it's a key part. It's a part of the story. And there's no magic in going for how Ryman Healthcare's turned its 9.8% return on operating assets into a return on equity of 21.4%. It can seem like magic, but it's not. Here's the formula. Here's how it works. Return on equity equals your return on operating assets plus your operating liability leverage, which is your return on assets minus your return on operating assets, plus your return on equity minus return on net operating assets, which is your financial leverage. So this is how it works for Ryman Healthcare. Ryman Healthcare, return on operating assets 9.8%, return on net operating assets is 14.4%, and its return on equity is 21.4%. You can calculate all these for your own firm. And so you can see how I've worked it through. 9.8% its return on operating assets. It then earns 14.4% minus 9.8%, which is 4.6%. That's the additional return it's getting from its operating liability leverage. That's moving from the return on operating assets to its return on net operating assets. So that adds 4.6%. And then the difference between its return on equity and return on net operating assets, which is 21.4% minus 14.4%, is 7%. So that's from its the financial leverage. So if you add all that together, you get from 9.8 to 21.4. So that's how Ryman Healthcare has been able to achieve, in that particular year, 2018, a 21.4% return to equity investors when its operating assets were up just going 9.8. And a key part of that story is that operating liability leverage from the money it receives from selling occupancy rights to its customers is essentially funding half of its operating assets. So that's a little look on leverage. So you can see that's part of the story for Ryman Healthcare's return on equity. So that's leverage. Let's have a look at profitability. Second part of the story. Now, profitability, we're looking at it as profit margins equals operating income after tax divided by sales. So for Ryman Healthcare, its operating income was $396.6 million. Its sales were $694 million. So its profit margin was 57.1%, 2018. Its 2019 accounts have recently come out, and I've calculated their profit margin is 53.3%. It's come back slightly this next year. But 57.1% is a mighty big profit margin. That means for every dollar of sales it's getting, it's making 57.1 cents profit. So you can compare that with your profit margin, your firms. There won't be too many coming anywhere near that. So Ryman Healthcare is really making a lot of money from certain aspects of its sales. When you go through its income statement, it's making revenue from aged care facilities, you know, where it's supporting people in care, and also its hospital and a few other things. But it's not making very big margins out of that part of its business. But it doesn't disclose, you know, its margins for all its bits and pieces, but you know that it's not making much margin there. But because it's government regulated and it's largely driven by payments from government, so they'll be monitoring what sort of returns they're getting. But it's making most of that profit margin is being driven by its sale of occupancy rights in retirement village units. It's selling a lot of those, and it also gets to resell them because people are on average in there for 7 years, and then when they die or move into care, the unit reverts back to Ryman's, and then they buy it back at 20% less than the person paid for it, and then they're able to resell it again. And if there's been growth in house prices in that area, then they can sell it for quite a lot more than 20% more than the cost. So they can get pretty good margins both out of selling new ones, but also reselling existing ones, just tuning through on average every 7 years. So it's making more than 57% on its retirement village unit sales. So it can build these retirement village units and within these centres, and people will buy them as occupancy rights, and they can make they're making big margins. Now, coming back to this chart, with clearly separating the operating and financial activities of the firm, this is very much grounded in finance theory, which you studied in business finance. Who studied business finance? Hannah, have you studied business finance? You can just put your hand up. Yes, yes. I know the microphones are never close, are they? Our ones are really close here. We can just press the button. But, and Justin in Cairns, have you studied business finance? While Justin's getting the microphone. Sarah in Western Australia, have you studied business finance? Have you done finance?
Yes, I have.
Yeah, it's core, it's compulsory, isn't it? And what about Oh, Justin, well done. It's quite a trek to the microphone, isn't it? That's good, Justin, you've done it. And what about Knock in Sydney? Knock Newen, have you done it?
Yep, I've done it.
When you turn the mic on, you then got to turn them off again. Otherwise we have problems. Well, when you studied finance, need the mics off. I think maybe whoever's got that on. When you studied finance, a key assumption underlying it is that we focus on the that we ignore the financing. For example, Merton Miller of Modigliani and Miller fame. Do you recall studying Modigliani and Miller theorems in finance? Why does this quote from Merton Miller of Modigliani and Miller fame in this chapter, that showing what doesn't matter can also show by implication what does? What does this mean to you? Do you recall the Modigliani and Miller theorems, underlying finance theory? Hannah, do you recall them at all? You can put a thumb down if you... No, you don't recall. Does anyone recall Modigliani and Miller? Very famous. Did you do them? No, you did. Well, what they said was... Modigliani and Miller feel is that you can is that financing doesn't add value. It's a key assumption underlying finance theory. And so they were showing, so it was focused on what doesn't matter. But what Merton Miller's saying in this quote is by telling us that financing, the assumption is that the debt markets are efficient, and you can't be making super profits. You can't be adding value through your financing. that underpins how financing activity works. But by implication, it shows what Merton Miller's saying here, it shows what actually does matter. So what does matter? And that's what we're interested in this unit. We're going to be focusing on the operating activities because we're going to be, it's an assumption, there's a focus that that's where the action is. Ryman Healthcare is making people rich. People who invest in Ryman Healthcare at the beginning have made a lot of money. Off the float, they've done over 40 times their money. People who are in earlier, in private equity, I was chair of a private equity fund that had an investment in Ryman Healthcare as a private equity investment. They also did very well. One of the original part owners, there were two of them, they've got a substantial shareholding, their family in Ryman Healthcare, which would be worth at least $400 million. So they've done okay. So what has made that happen? It's in the operating activities. So that's why we're going to be focusing on the operating activities. And that's why I'm going to be focusing on Ryman Healthcare's operating activities. So we're going to be making a shift pretty soon. See, by focusing on return on equity, we're focusing on the whole company, which includes the financing. But we'll be pretty soon starting to focus on the operating activities. What benefit might there be in focusing on the enterprise of a firm, which is its operating activities, rather than on its equity? What risks or dangers might there be in this approach? So as we start to shift by focusing on the operating activities and you'll be coming up with an enterprise value for your firm, what benefit is there in doing that? What do you think? Sharon, what do you think? Or anyone? How about Sarah? Sharon's not finished, you are. How about Sarah in Western Australia? As we start to ignore some part, all the financing, and really start to focus on the enterprise, the operating activities, what benefits might there be in doing that?
You don't have the influence on the results from the group to a certain extent. Like equity accounts for part of the influence the group has and on non-controlling interests of the business versus the actual operations, which are what are used to generate income. So that makes it more centralized on what the activities of the actual firm as opposed to it's part of a larger network. But the danger in that is, of course, that the larger network has influence on what the firm does, earns, and how it operates in and of itself. So by not looking at that, you limit yourself in what you identify.
Well, Sarah, we will still be focusing on the consolidated group. We'll be focusing on the consolidated group, not on the company. Like Ryman Healthcare, most of its operations are actually in its subsidiaries. So if we only looked at the company, if we didn't look at the group, we'd miss out pretty well on everything, almost everything Ryman's doing. And that's the same for a lot of ours. So we're going to be continuing to look at the group, but we're not. So it's still a group, and that includes all the minority interests or the non-controlling interests. Like it's 100%. What it is, we're looking at 100% of the operating activities or of the group. 100%. So that includes, if you like, the non-controlling interests. So we're not cutting out that part, so we're keeping all that in. So that's not part how we're simplifying it. We're excluding the financing of everything. And so, does that make sense to you, Sarah?
Yeah, I mean, I suppose one way of phrasing it that I find it very hard to explain, I guess, is that we're trying to cut out the influence of the equity investors on the results because financing comes from debt and equity investors. So part of the debt is part of the operations, but equity invested is part of your financing activities. Like it's really weird to explain, I guess.
I know. I understand what you're saying. Is that what you're saying is that you could influence, say, your ratios or your like your return on equity. You can clearly influence it by how you finance. You know, all that financial leverage, big part of the Ryman story for the return on equity. But if we're going to focus on the operations, if that leverage, financial leverage, doesn't add any value, right? Say that's the case, which is the Modigliani and Miller theorems that underlie finance theory. We focus on the enterprise, then we're going to exclude all that. And that's like sort of noise that would just make the numbers, you know, like your firm might be increasing its debt over the last few years, and that might be driving up its return on equity. But that doesn't mean it's adding any more value. Certainly under the Modigliani, Miller and the finance theory, it doesn't. And that's how we're looking at it. So I think that's my reading of what you're saying, Sarah, which is exactly spot on. Does anyone else have any thoughts about the benefits of focusing on the enterprise, on the operating activities, and excluding the financial activities? Any other thoughts?
I described in one of my KCQs that the business is like a machine.
This is Sharon Field in Rockhampton. The business is like a machine, Sharon, yeah? Actually, I've got your mic. You need to turn the mic over. I've turned that. Sharon?
Hi, everyone. So if the business is like a machine and the financing is like the fuel, then the operation is what you use the machine for. So that's what you put the fuel in it for.
Yeah.
So then we focus on the operation without the fuel and see what it churns out.
It's not going to churn out anything without fuel, though. I don't know. That doesn't sound good. We're going to study it without the fuel? What does that mean?
Yeah.
What do you mean? Do you mean that the fuel... Yeah, what do you mean?
I mean, we can see what the firm's really doing, what it's going to do once we add the fuel to it.
We can always leverage the returns up. But in finance, when you study finance, what you learnt then was that as you leverage it up, all you do is increase the risk. And so that's offset by the increased return on equity over return on net operating asset. The leverage gets you a higher return on equity, a higher return, but it also gives you an equivalent and equal amount of risk. So on a risk-adjusted basis, you're not adding any value. Risk is important because we don't know the future. We don't know what's going to happen on Saturday afternoon, you know, let alone out the future in detail. So risk is important, and that's the thinking. So we're going to be focusing on the enterprise, but what risks or dangers might there be in our approach? Yvette, what do you think?
It seems a bit vague, sorry, Martin. I'm not sure I'm fully comprehending what we're asking.
Yeah, what we're going to do is we're not going to focus on we're about to cut out the financing side of our businesses in our analysis, and we're just going to focus on the operating activities. And we'll get right into all of that, and off we go, and you can get very focused on the numbers. We don't want to get too focused on the numbers. We want to look through to the operating activities. But if we completely neglect the financing activities, which is what we're going to do, we're going to focus. What risks are there in that? Do you think, Yvette? Does that make sense?
Yeah, it does, I guess. I suppose one of the biggest risks is a lot of companies rely solely on their financing to, pump out the operating. So cutting them all out, I guess, is it going to give a more accurate view of how the company is making its profit? Because some companies make profit from their financing.
They do. They leverage their returns up with financing. That's right. Yeah. Well, the risk of ignoring the financing is companies can go bust. and they do that by having, they do that by not being able to pay their debts back. They haven't got enough cash to. So if we can't completely ignore the financing activities, we've got to have eyes in the back of our head to make sure that things aren't going awry there. For example, Ryman Healthcare has negative free cash flow. We'll see that in the analysis. Quite significant negative free cash flow, yet it pays dividends. Pays 100 million in dividends. So how does it fund its dividends if it's got no free cash flow? Well, it funds its dividends by borrowing money. And so it borrows money and it pays it. And so some people go, oh man, that sounds bad news. Is Ryman's just, So, you need to keep track of how things are being funded and see what the financial risks are, because companies can go bust. Ryman Healthcare, by the way, is fine. It's got very little leverage, as you can see in that. It's only funding a small part of its operating activities with financing. And it can easily, the banks would lend it heaps of money. So there's no real issue in the medium term for Ryman Healthcare. But, you just need to keep, my point is just keep it, we need eyes in the back of our head not to completely ignore the financing activities as we're about to focus on the operating activities. So we'll keep moving. So we've looked at leverage and profitability as two drivers of return on equity, and we've talked about how we're going to be looking just at operating activities, the operating profitability, and we'll be looking at the operating leverage, but we'll also be looking at the efficiency. Oh, here we go. I've got some questions. That's right. We'll get back to that. I just want to go a little bit further than I expected, and then we'll go back to the minute paper. I thought we'd probably get to about here. But let's have a look at efficiency. That's the third aspect of what's driving return on equity for Ryman Healthcare. Efficiency. Efficiency often gets a bit neglected by managers. Profitability, everybody just has a natural inclination to, it's easy to sort of focus on your profit margins, but profit margins in and of themselves don't count. There are plenty of Ryman Healthcare's got a huge profit margin, which is great, but there's plenty of businesses that have quite small profit margins that are hugely successful. And it's because it's not profitability by itself that counts, but it's the relationship between profitability and efficiency that makes you rich. And good managers, that's what they focus on in their businesses. And what's efficiency? Asset turnover, ATO, asset turnover. It's the relationship between assets, we're using net operating assets, and turnover, which is another word for sales. So it's the operation between sales and net operating assets. It's the amount of sales we're getting out of each dollar of net operating assets. It's all very well to have a good profit margin where you're getting so much profit out of each dollar of sales. But how much do you have to invest into your business? That net operating assets, that's your capital employed in the business. That's what Ryman Healthcare's got to invest in the business to generate those sales. It's all very well to make a lot of money per dollar of sales, but how much of your capital, of your net operating assets, are you having to invest in the business to generate those sales? That's what asset turnover is about. That's the amount of, that's how many dollars of sales you get, how much sales do you get for each dollar of net operating assets. Or we can also look at the inverse of asset turnover, 1 over asset turnover, which equals net operating assets to sales, which is how many dollars of net operating assets do we need to invest in the business for each dollar of sales. So how's that working for Ryman Healthcare? So you can see the efficiency, the return on net operating assets, 14.4% for Ryman Healthcare. Key part of its value driving is the relationship between profit margin and asset turnover. So this is a key formula. Return on net operating assets equals profit margin times asset turnover. If you remember nothing else in the unit, that is a really good relationship to keep in mind. And that's regardless of what disciplines you're working in or how you're working in business, particularly as you get more senior. In every area, we're looking for people to be able to manage that relationship and to maximise it in a business. So Ryman Healthcare, it has sales of 694.1 million. Its net operating assets, because its net operating assets are growing so strongly, I use average net operating assets. You see, a ratio is the relationship between two items, and it's how they're interacting with each other. Now, the sales are over a 12-month period. So what we're interested in is what were the net operating assets over that 12-month period that we used to generate the sales. Because Ryman Healthcare's got, if we used opening or closing, we'd get quite different figures for Ryman Healthcare's efficiency. But because it's growing gradually through the year as it's building more retirement village units, it's not suddenly jumping around. So it's more smooth movement. I tend to use average for net operating assets. If your net operating assets is quite stable, well, doesn't matter which one you use. You can just use closing or opening, they're much the same. But if they're varying a lot, then there is an issue of how you're going to calculate what net operating assets figure you're going to use. In a strongly growing company like Ryman's, its net operating assets is growing substantially. And it's typically growing by $500 million a year in recent years. So that's, so I use average, and the asset turnover is 0.25 times, which is low. Typically, firms might have 2. You might find your firms have around 2. Certainly 1 to 3 would be pretty common. So Ryman Healthcare is efficient. It doesn't make much sales out of its net operating assets. And in business, like in life, there's often trade-offs. If I spend time studying on Act 13017, I can't go out to the beach or something. So there's a bit of a trade-off with everything we do. And the same with profit margin and asset turnover. There tends to be a trade-off. And so this is a graph out of the study guide. And this is the relationship between profit margin, which is on the y-axis on the left-hand side, and asset turnover on the bottom. And these are all the points that give you 10% return on net operating assets. So you can see as the asset turnover grows for most businesses, the trade-off will be your profit margin will get less and less, and vice versa. So Ryman Healthcare, you see, it's got a low asset turnover, but it's got a high profit margin. It's not on that graph. It's above that graph because it's earning more than 10% return on net operating assets. So it's sort of around. It's got 0.25, but its profit margin's off that graph. So you'll probably see that with your firm, that there'll be a relationship between profit margin, asset turnover. If you've got a higher one or a lower one, you'll probably find your profit margin is in a reverse relationship. Now, I'm going to just wrap up on this before we discuss some other issues on the minute paper, but we're just going to revisit leverage briefly as we're looking at asset turnover. We can also look at return on equity equals return on net operating assets plus financial leverage times spread. I talked about how financial leverage was the difference between return on net operating assets and return on equity. Financial leverage is the amount of our net financial obligation that we have, and the amount of that compared to our net operating assets. But it's actually, there's more to it than that. Ryman Healthcare gets a lot of leverage out of it. It doesn't have a huge amount of financial leverage in that it doesn't have a lot of net financial obligations compared to net operating assets, but it gets a real kick out of it, 7% kick, because it has a lot of spread. So it's the relationship. What drives that financial? It's not just financial leverage. It's the relation. It's how much sort of energy, how much leverage you get out of the financial leverage, which is spread. Now, spread is the difference between your return on net operating assets and your net borrowing cost. In other words, it's the difference between what your return on net operating assets, which is your return on your operating assets after your operating leverage, your return on net operating assets. Ryman's has got a very solid 14.4%, less the net borrowing costs, which for it is very low. And so it's got a big difference between the return on net operating assets and the net borrowing cost. If your firm earned exactly the same return on net operating assets as it costed to borrow, net borrowing costs, you could have as much debt as you like in the business, and you get no leverage from return on net operating assets to return on equity. You need the spread and the financial leverage together. So Ryman's gets a lot. It's got a big spread. You can see what your spread is when you're looking at your firm. So return on net operating assets, which is operating income over net operating assets, and net borrowing cost is your net financial expenses divided by your net financial obligations. So all of these you can calculate from your stated financial statements. So you can see how we can look at how that leverage is working between return on net operating assets, Ryman's 14.4%, and how it gets to return on equity of 21.4%. And so Ryman's has heaps of spread. Its return on net operating assets 14.4%. Its net borrowing cost is 1.3%. There's some reasons why it's so low, but we won't go into that. 14.4 minus 1.3. It's got spread of 13.1%. Every time it borrows some money, it's leveraging up its return on net operating assets a lot. Your spread will probably be less, but see what you can calculate it. So in Ryman Healthcare's case, return on net operating is 14.1%. Its financial leverage, that's its net financial obligations over net operating assets, 0.533, but it's times 13.1%, which equals 14.4 plus 7. So it's increasing it by roughly a half. It's 14.4 to 21.4%. So that's another way that we can look at leverage in getting from our return on net operating assets to return on equity. So you can see that financial leverage, that 0.533, is much more effective if you've got a decent spread, 13.1. If that spread was just 1%, it would, make a much smaller difference. And then when we go back and look at what we looked at earlier on leverage, you can see return on equity, which for Ryman Healthcare is 21.4%, is its return on operating assets 9.8%, plus its operating leverage, liability leverage, 14.4 minus 9.8, 4.8. And then you can see the difference between 21.4 to 14.4 is 7%. You can see how that's the financial leverage times spread. So it's not just financial leverage, it's debt to, it's debt to equity, but it's net, as we look at it, the net financial obligations to net operating assets, which is like the debt to total assets. It's 21 point. It's not just that leverage, but it's the spread as well that's driving that 7%. That's causing it to get to 21.4. And actually, we did this as well. And then we'll just see that and you can see that the return on net operating assets, now that we've looked at leverage as well as profitability, for Ryman Healthcare, it's driven by a very high profit margin. This is driven by some of the ways the accounting treatments of sales works for Ryman Healthcare, where sale of occupancy rights doesn't feed into the sales, but because it's just leasing them, it's not renting them, not selling them. So there's a little bit of accounting in there, but the 57.4% has a very strong profit margin and a very low asset turnover to give 14.4. So when you calculate your return on net operating assets for your firm, you can see if it has a better one than 14.4. Ryman Healthcare used, in days gone by, had 30%, 20%, 30%, 40% return on net operating assets when it was smaller. It's got a lot of net operating assets now, and so it's gradually coming down, and it's continuing to come down. But it's earning these sort of returns on a mighty big amount of money now, so it's still able to generate quite healthy, $100 million plus economic profit each year. So I managed to get through that leverage revisited and the as well. If I go back now, if you go back on the slides to where I was sort of planning to stop, let's do the minute paper now. What was the most important thing you learned today, and what questions still remain unanswered? You might have quite a few questions. So you've got 1 minute. What was the most important thing you learned today, and what questions still remain unanswered? Got 2 responses. 30 seconds to go. What was the most important thing you learned today, and what questions still remain unanswered? I've got 4 responses. 5 responses. What was the most important thing you learned today, and what questions still remain unanswered? I learned that the calculation for a return on equity involves the calculation of other percentages together to give the overall percentage. And that's similar to the next one. Return, which is a bit more precise. Return on equity has 3 aspects of profitability, leverage, and efficiency. So that's a key message that we did look at today. We know that we're going to extract the financial side out of all of this, and you can see how it's sort of entwined into all this. But this is the picture on those. So analysis is about breaking things into bits to see what's driving things, what's making things work. Very much like my youngest son used to do this. He used to break up lots of things into bits to try and figure out how they worked. And it's very much the same thing. What's driving return on equity? Well, it's profitability, leverage, and efficiency. And you can see how that works with Ryman Healthcare, how it's managed to turn 9.8% return on operating assets into 21.4% in the hand of the shareholders. So it's through leverage, through various elements of leverage. And you can see how we can keep breaking things down. When focusing on leverage and profitability, it is still important to focus on the operating aspects of the firm. Yes, well, very soon we'll be focusing fully on the operating activities of the firm. So we're still we're hovering around here. Usually at this stage of the unit, people start to get a little bit afraid that maybe they're not going to be able to do their analysis too well or something. So that's good. That's sort of the idea. We're just stimulating them along. But don't worry, you'll be able to do it. Everybody can do it. It's just a question of how well your analysis is, and how thoughtful and convincing. But when focusing on so we're going to be focusing on the operating aspects, but we're spending a bit of time focusing on the broader issues so that you've got a little bit of context. Efficiency of Ryman Healthcare. The efficiency, the asset turnover, very low. It has a lot of assets, very low sales. Again, it's partly a factor of the fact that because it doesn't actually sell retirement village units, it keeps them all. It's just giving out leases. That sort of causes the figures to shift. That is partly the reason why it's got such a low asset turnover. But that's how the accounting treatments work. And it isn't actually selling those retirement village units, it's keeping them all. So it's got a very low asset turnover. A good chunk of a firm's success comes from financial leverage times by spread to strengthen the leverage of the firm to increase its ROE. this is a very interesting point that you've made there. Return on equity is, you can see in Ryman Healthcare's case, can be driven a lot by financial leverage. If you believe your studies in finance theory, I'm not clear that anyone can even remember too much about this stuff in their finance theory. Finance is a critical discipline in business, like every other one. But if in a critical assumption in that theory is that the financing doesn't matter. You can't make money. You're not going to get rich just leveraging up your numbers because you're going to be increasing the risk. And risk means a broader range of potential outcomes. So you can leverage up your company, but it's the operations that are going to drive the value. And if they go wobbly on you and up and down, as that's what the world's like, if you've leveraged it, you leverage down as well as up. And so you're just taking more risk. You're not going to get rich that way in the long term. So quite a lot of its return on equity can come from financial leverage. But finance theory, which we're drawing on, it suggests that doesn't add value. And so it's sort of like noise. We want to know what's really going on in our firms. So that's why we're going to narrow in on the operating activities. What's driving or value creation or value destruction in your firms? There are plenty of firms destroying value as well as creating value, of course. So, yeah, that's an interesting observation. But, of course, that's right. Firm success can come from its financial leverage, but we're looking for value add and creating value. That the main item that we will look at is ROE, abnormal profit, and to see if it is worth investing in a company. That's right. We'll be very much focused on the economic profit. We're going to do DCF, discounted cash flow, and economic profit valuations of our firm, but we'll be particularly focused on economic profit. Our definition of economic profit has been abnormal earnings at the moment, but we're going to shift that to abnormal operating income. So we're going to shift it to the to an operating measure of economic profit. Economic profit is the profit over and above the cost of capital, times by the... I must have pressed something. What happened? There we go. There are three drivers: leverage, profitability, and efficiency. So that's great. So that is a key takeout, that you can see how we can break these things into bits. And we're also getting some sense, I think, or at least I'm just flagging it a little bit, that I'm going to disentangle the financial side of things and focus on the operations. So what questions still remain unanswered? I'm still wondering how we are to decide what figures to use for our predictions, or whether it is arbitrary on our assumptions of future figures based on prior figures. That's an excellent question. See how we're focusing on the past currently? And we'll be doing again next week. We'll be doing it for a while. We're only focusing on the past. But the idea is, if we can understand the past, what's driving Ryman Healthcare's we'll be focused on return on net operating assets and the operating side, but currently return on equity. What's driving that in the past? Well, if we can understand what's happening in the past, that's our beginning point for thinking about the future. But it's not enough just to look at the accounting numbers. There's no evidence. Ryman Healthcare earned 14.4% return on net operating assets in 2018. There's no evidence that that's going to tell us what it'll be in the future. What's it going to do in the future? Well, the fact it's 14.4, that doesn't tell us what it's going to be in the future, or any ratios. There's no evidence. I know that people sell sort of their views that they think these ratios are indicative, but there's actually no, it's all been researched thoroughly, and there's no evidence that any accounting numbers predict the future for firms, except there's some evidence around corporate failure. But we're focusing on corporate success, no evidence. So what we have to do in order to be able to predict the future, we have to go through the accounting numbers with the ratios. You're going to be narrowing down to some key elements of drivers, accounting drivers of value. We then need to link them to the economic and business drivers. And we'll be talking about that next week. and also how we linked Ryman Healthcare's, how I've done that. And it's those economic and business drivers that we forecast. It's not the accounting numbers. We're going to forecast. So for Ryman Healthcare, the key economic and business drivers that I've identified, some of them are residential house prices. As they go up, as residential house prices go up, Ryman Healthcare can charge more for its retirement village units, for its occupancy rights. Because people are selling their homes in the area and buying in. So if house prices go up 50%, they can charge 50% more. So that's great for their profit margins. So what do I think about house prices going forward? It's particularly around their retirement villages, 10 kilometres around. But there are questions about how much detail you go into, but certainly the overall house price situation. So you form a view about what that's going to be in the future. That may be quite different to what it was in the past. Also, there are other economic and business drivers that we'll look at next week for Ryman Healthcare. And so as you're looking at the accounting numbers, you're breaking them down into bits. What happens is you start to, and you know a bit about your firm and what it's doing, you start to think to yourself, well, you know, I think this is driving this aspect of the business, whether it's a good number or a bad number. You know, it's that judgment, that leap into the economic and business drivers that's key. And it's still all in the past, right? But it's the economic and business drivers that we'll be forecasting later in the term. And then we have to link those back to the accounting numbers in the future. That's how we're going to forecast the numbers. And it's good to be wondering how you're going to do that, but we work together through it. You know, there's a lot of support as we go along. And it's the quality of those assumptions. If we think our forecasts, and, you know, I say, I think house prices are going to go up 30% a year for the next 5 years. I've just pulled that out of nowhere. Well, that may not be very convincing. Because why do you think house prices are going to go up 30% each year? But if you think, and I've got my forecasts very simplified in the study guide, I've got forecasts where I think house prices will be flat for the next few years, and these are the reasons why. Right? And you go through your analysis of house prices and what's happening, and then I think I have them growing slightly towards the end of my 5-year forecast horizon. So you say, if you've got some reasons for it, you think, well, that's reasonably convincing. So that's more to think about. Martin found an average NOA, but where do you get the 2+ figure from one financial statement? Oh, I see what you mean. Yeah, I used opening and closing net operating assets. So net operating assets is out of the restated balance sheet. The restated balance sheet is at a point of time. So the 31st of March 2018 is a point of time. I'm using the 18 figures. And then the 2017 accounts, the March 2017 accounts for Ryman Healthcare, also has net operating assets. So the last year's balance sheet is the opening figures for this year, and the closing figures are this year's balance sheet. So that's where I got from the restated financial statements. You just go back a year for the opening and the current one for the closing. And I've used average because it's growing. You can think through that, which one you use, whether you want to use average or, you know, if it's not growing much, you can just use closing, that's all right. What is determining leverage important for a business, and what's its main purpose? Yeah, so we broke leverage up into financial leverage and operating liability leverage, right? And we're going to be breaking everything up into operating and financial. So, but leverage, if we think of financial leverage, which is what most people, in terms of leverage, most people are referring to financial leverage, or they're usually referring to financial leverage. The question is, why is determining leverage important for a business, and what's the main purpose? That's right, leverage. This is something you would have discussed when studying business finance, is that, you know, if the theory is that it doesn't matter what your leverage is, and one of the there are a number of key assumptions under the Modigliani and Miller theorems, but one of them is that the equity investors can borrow at the same rate after tax as the company. So if that's true, if I can borrow money at the same rate as Ryman Healthcare, then who cares whether they borrow? I could borrow the money and buy shares in the company, or they can borrow the money. You know, it won't make any difference. That's that type of thinking. These are assumptions underlying the model. So, but of course, a lot of people look at return on equity and these sort of figures, and also, you know, dividends that they might be wanting to get. So the decisions on dividend policy and on leverage have a role to play in how you position yourself in the market. But so Ryman Healthcare, I don't want to get too much into finance, but there's some good questions you're asking in terms of why is leverage important when we've just said it's not, you know, based on finance. We're going to disregard it. Why do companies put so much effort into it? Why are they positioning themselves vis-a-vis the leverage, dividend policy and levels of borrowing? Why does Ryman Healthcare operate the way it does? They're good questions, but we're not really going to go into those in this unit. But they're the things for business financing. And we can talk about them a bit more as we go along. Does separating the financial from the operating activities help identify and manage risks on ROE and future ROE? Well, we're going to stop looking at ROE pretty soon. We're going to be looking at return on net operating assets because we're going to focus on the operations. Return on equity includes financial activities. It's looking at the company as a whole. Return on equity is the company as a whole. But within the company, you know that chart where we have operating and financial activities? Well, the return on net operating assets is looking at the return on the operating side. Return on equity is looking at the return on both operating and financial activities. So we're going to pull away from having looked at return on equity, and we'll continue next week, but then we're going to pull away and narrow down to return on net operating assets. The reason we do this is to give you a sense that we are leaving stuff out. And but you're right, when we look, we'll get to sort of leveraged and unleveraged ratios. Typically in the financial press, on financial websites, they'll have levered ratios. In other words, they'll be, you know, the company rather than the operations. And we'll be looking at unlevered ratios as well and seeing what you can find out, focusing on the unlevered. And often the financing activities are used to generate better levered ratios that the markets, media and so forth can focus on, but that can disguise what's actually going on. So the unlevered ratios can help us focus on the operations. But something to think about as we're going through. But the answer to that question is, I think, yes, separating the financing from the operating activities does help identify and manage the risks of ROE and future ROE. And, you know, I focus on return on net operating assets. I don't care about the ROE on Ryman's, but I focus on the return on net operating assets, which has been coming down and is continuing to come down significantly, and I focus on that. It's raising its leverage, which can keep the return on equity up, but I don't really focus on that. What happens when there is not much operating compared to financial? Do we still look at operating? I like that. Yes. Yes, we're looking at the operations. But what you're talking about is some limitations to what we're looking at. You see, Ryman Healthcare is a very predictable business. Have we stopped? Are we still on? We're still going. Schedule. Oh, I see. Events come up on the screen. Scheduled meeting ends in 5 minutes. Yes, the Ryman Healthcare is one of those. Is a classic firm that's pretty predictable. It's got growing, consistent cash flows. They're the ones. They're the businesses I like. And the nature of its business makes it predictable. It's going to resell, on average it resells occupancy rights to retirement villages every 7 years. So you can look back 7 years, see how many occupancy rights it sold then. And on average, you can expect to sell them now. And then you can look back at the increase in house prices and other things, and you can see that you can, and then it just keeps, so it's got a whole backflow of future cash flows as it just keeps recycling things. Plus it's got building program going forward. It's got a whole lot of land that is bought, land bank for quite a few years worth of future growth. So it's a sort of predictable sort of business. But other businesses can be very unpredictable. You know, picking the tech space, they're very unpredictable. I can never, so these techniques can be more limited in certain areas. If you're in the biotech area or in other technology areas, that can be very difficult. They're very hard to predict. And there's a range. So that's something for you to think about, how these methods can be used. So if you haven't got much operating, you know, if it's a bit of a startup or it can be very hard, it's much harder to predict what its value is. What is ATO meaning? Yeah, ATO, it doesn't mean Australian Tax Office. ATO, see all these symbols. ATO means asset turnover. A for asset, TO for turnover. Asset turnover, that's ATO. A for asset, TO for turnover, and turnover is another word for sales. So asset turnover is the relationship between assets and sales. And what we look at for our asset turnover, as we focus on the operations, is sales divided by net operating assets. It's the amount of sales for each dollar of net operating assets. If I'm interested in maximising my return on net operating assets, which is the capital I have employed in the business, then the more sales I can make for each dollar of net operating assets, the better. And then that relationship with how much profit I make per dollar of sales is what drives return on net operating assets. Hope that helped. All right, we've got 2 minutes left. Who would like to ask any questions or make any comments? Hannah and Mackay, how are you going?
I'm good.
Now, I know that in this part of the unit, people can start to feel a little bit like, man, I'm going to have to forecast my firm and I don't really know what I'm doing yet. Don't worry, just come on the ride. We're building those blocks as we go. And it's also a chance for you to review what you may have learnt or not learnt in different units you've studied, so you can review what you've got, fill in some gaps, and also look at the relationships between some of the areas of study that you've done as well.